Hi and welcome to our channel. In today's video, we'll discuss an interesting topic that might change the way you see the market's volatility. But what if I told you it's actually a hidden opportunity? That's what we're going to explore today. And no, this isn't about timing the market. It's about time in the market and a strategy called dollar cost averaging, or as it's known in India, Rupee-Cost Averaging. You can gain benefits from those crazy ups and downs that most people find scary. Continue watching to learn how. Let's begin. But first, a quick introduction to PA Wealth. We're an investment services group offering stocks, PMS, mutual funds, alternative investment funds, insurance, and startup investments. We upload research videos on different companies, mutual funds, and financial topics every week. Subscribe to our channel and hit the bell icon to stay updated on the latest market trends and potential multi-bagger stocks. Let's start with why volatility is your friend. Volatility equals opportunity. So what exactly is market volatility? The swings in stock prices. One day they're up, the next day they're down. For many, these swings are stressful, but for savvy investors, they're like a sale at your favorite store. Let's break it down. Imagine you're investing a fixed amount every month, say 10,000 rupees in a mutual fund. When the market dips, that 10,000 rupees buys you more units. When it rises, you buy fewer units. Over time, this lowers your average cost per unit. The catch is that when the market recovers, the units you purchased during the downturns appreciate in value, increasing your overall gains. Now, let's take a real-life example. Suppose you invest 1 lakh rupees every month for a year. In a steady growth market, prices rise gradually. You end up with 10,874 units, and your portfolio grows by about 8.67%, giving you 13,03,990 rupees. In a volatile market, prices swing up and down. Here you accumulate 11,446 units more than in the steady market, and your portfolio value rises to 13,73,552 rupees, a return of 14.46%. That's a difference of over 69,000 rupees. By embracing volatility, you could significantly enhance your returns. Now let's understand the power of Rupee-Cost Averaging. Now the secret sauce here is consistency. Rupee-Cost Averaging works because it takes the guesswork out of investing. Instead of trying to predict market highs and lows, you stick to a schedule. Here's why these matters. When prices drop, you get more units for your money. When prices rise, the units you already own increase in value. It's a win-win for long-term investors. Now let's see how overcome the fear of volatility. Volatility can feel scary. But remember, it's a natural part of the market. Historically, markets have always recovered, and the patient investor has always been rewarded. The key is to shift your mindset. Instead of seeing dips as losses, view them as opportunities to buy more at a discount. Here are the key takeaways. 1. Market volatility can help you lower your average investment cost. 2. A consistent investment strategy, like Rupee-Cost Averaging, thrives in volatile markets. 3. Don't let emotions drive your decisions, stick to your plan, and let time do the heavy lifting. That's all for today. If you found this video insightful, give it a thumbs up and subscribe for more research-based financial content. Don't forget to click the bell icon for alerts on potential multi-bagger stocks. Got a topic you want us to cover? Drop it in the comments below. Thanks for watching, and we'll see you in the next video.